Here's a fact that sounds like it can't possibly be true. For the first 124 years of its existence, the United States had no permanent income tax. Think about what that actually means. No withholding line on your pay stub, no deadline circled on the calendar every April, no federal agency with the power to open your books and ask where every dollar came from. For 5 generations, an American could be born, work an entire lifetime, and die without ever handing Washington a single cent of their wages. And yet during those same years, this supposedly penniless government bought Louisiana from Napoleon, fought the British Empire twice, built a navy, funded an army, and stretched a republic of 13 coastal states into a continental power reaching the Pacific. In 1835, it even did something no major nation has done before or since. It paid its national debt down to 0. So the obvious question, the one nobody ever answered in school, is simple. Where did the money come from? And there's a bigger question hiding underneath it. What exactly happened in 1913 that flipped the entire system on its head and quietly rewrote the relationship between you and your government in ways we now treat as normal? Because the answer is not dry tax history. It's a story of armed rebels tarring tax collectors on the frontier, of a tariff that nearly tore the country in half 30 years before the Civil War, of the most corrupt office in America, and of a Supreme Court ruling so explosive that one justice accused his own colleagues of surrendering the government to the rich. Here's the part that matters. The founders didn't forget to create an income tax. They deliberately designed the Constitution to make one nearly impossible. This is the story of how that wall was built and how, brick by brick, it came down. To understand why the founders were so allergic to taxing income, you have to go back to a country that had just won its independence and was, by almost any measure, broke. The Revolutionary War ended in 1783 with a victory on paper and a disaster on the ledger. The national government owed roughly $54 million, an almost incomprehensible sum for an agrarian nation of under 4 million people. The states had piled up another 25 million on top of that. Soldiers had gone home unpaid. Foreign lenders in Paris and Amsterdam were holding American promises that looked increasingly worthless. And here's the detail that gets left out of the textbooks. Under the Articles of Confederation, the national government had no power to tax anyone at all. It could send the states what were politely called requisitions, which were essentially invoices with no enforcement behind them, and the states treated them exactly the way you'd expect. They ignored them. In some years, Congress received less than a fifth of what it asked for. The government of the United States was reduced to a debtor knocking on the doors of its own members, hoping someone would answer. By the mid-1780s, the situation had become humiliating enough that it helped drive the states to Philadelphia in 1787 to write an entirely new constitution. The men who gathered there agreed on one thing immediately. A government that cannot fund itself is not a government. So the new Constitution handed Congress broad power to lay and collect taxes, duties, imposts, and excises. But read the fine print, because this is where the founders revealed exactly what they feared. These were men who had just fought a war ignited by taxation without representation. The very last thing they intended to build was a distant central government with an unlimited pipeline into every citizen's pocket. So they installed a safeguard. Article 1, Section 9, no capitation or other direct tax could be levied unless it was apportioned among the states according to population. That word, apportioned, sounds like a technicality. It was actually a lock on the front door. Apportionment meant that if Congress wanted to raise, say, $10 million through a direct tax, it couldn't simply set one rate for every citizen. It had to carve the $10 million into state-sized quotas based on headcount. A state holding 10% of the population owed 10% of the money, whether its people were prosperous merchants or struggling farmers. Run the math and the result is absurd. A poor farming state would see its citizens charged a far higher effective rate than a rich commercial state next door. The founders understood this perfectly. They made direct taxation legal in theory and unworkable in practice, then quietly threw away the key, which raises the question they left for their successors. If the government couldn't reach into anyone's pocket directly, how was it supposed to pay for anything? The answer arrived within months of the new government taking office, and it came from the mind of a young immigrant, still in his 30s, who understood money better than any man in America. On the 4th of July, 1789, before there was a Supreme Court, before there was even a Bill of Rights, President George Washington signed the Tariff Act of 1789. It was only the second law the new Congress ever passed. That timing tells you everything about the priorities of the moment. The United States needed revenue before it needed almost anything else. The system Alexander Hamilton championed was elegant in a way modern tax codes can only dream of. Every time a foreign product entered an American harbor, British cloth, French wine, Jamaican sugar, Chinese tea, The importer paid a duty at the dock. That was it. That was the entire machine. No returns to file, no household visits, no army of examiners. Enforcement required nothing more than customs collectors stationed at a handful of Atlantic ports. For a young country that imported most of its manufactured goods, the receipts were staggering. According to the economic historian Douglas Irwin of Dartmouth College, customs duties supplied roughly 90% of all federal revenue from 1,790 all the way to 1,860. In some years, it touched 95. One kind of tax, collected at a few dozen docks, carried the army, the navy, the courts, the diplomats, and the debt. Hamilton, though, was never just filling the treasury. In his 1791 report on manufactures, he laid out a second purpose hiding inside the first. Tariffs would make European goods more expensive, which would nudge Americans toward domestic alternatives, which would nurture the country's infant industries until they could stand against British competition on their own. Revenue on the surface, industrial strategy underneath, and the results were hard to argue with. Federal income nearly tripled in a decade, from about $3.7 million in 1792 to over $10 million by 1800. American bonds, junk paper just 15 years earlier, were soon trading above face value in European markets. A bankrupt confederation had become, in the span of a single generation, one of the best credit risks in the Western world. But the tariff system had a shadow side, and it's one the polite histories tend to skip. All that money flowed through a small number of choke points, and choke points breed power. The greatest of them was the New York Custom House, which by mid-century was collecting the majority of the entire federal government's income at a single address in Lower Manhattan. The man who ran it, the collector of the Port of New York, controlled more cash and more patronage jobs than almost anyone in Washington. Under a practice called the moiety system, customs officials personally pocketed a share of the fines and seized cargo they uncovered, which meant the office wasn't just powerful, it was lucrative beyond reason. In some years, the collector of the port took home more money than the President of the United States. Political machines fought viciously for control of that building, and more than one national career, including that of a future president, Chester Arthur, was minted inside it. Remember that, because it's a preview of a lesson this story keeps teaching. Every revenue system, no matter how clean its design, becomes a battlefield for the people who want to stand next to the spigot. Hamilton, to his credit, saw a different weakness. Tariff income rose and fell with trade, and trade could be strangled by war, embargo, or panic. The Treasury needed a second leg to stand on. So in January 1791, he proposed what looked, on paper, like a modest insurance policy. An excise tax on domestically distilled spirits. Whiskey. Congress passed it. Washington signed it. And with that one signature, the federal government reached inland, past the docks, into the daily life of the American frontier for the very first time. The frontier reached back with a torch. To understand the fury, you have to understand what whiskey actually was west of the Appalachians. It wasn't a luxury. It was the economy. Farmers in western Pennsylvania grew rye and corn in country with no decent roads. Hauling raw grain over the mountains cost more than the grain was worth. Distilled into whiskey, that same harvest became compact, durable, and valuable. Out there, whiskey settled debts, paid hired hands, and changed hands as currency, in places where actual coins were almost never seen. A tax on whiskey wasn't a tax on drinking, it was a tax on money itself, imposed by men in Philadelphia who, as far as the frontier could tell, had never crossed a mountain in their lives. Worse, the law's structure favored big eastern distillers who could pay a flat annual rate that worked out to roughly 6 cents a gallon, while small seasonal farm stills paid closer to 9. The little man paid the higher rate. Sound familiar? The response escalated the way these things always do. First paperwork, then threats, then blood. In September 1791, a tax collector named Robert Johnson was ambushed by a gang disguised in women's clothing, stripped, tarred, feathered, and left humiliated in the forest. Officials who tried to rent offices for tax collection found their barns burned and their notices answered by a shadowy avenger who signed his warnings, Tom the Tinker. For 3 years, the government's writ simply stopped at the mountains. Then, in July 1794, it stopped being a protest and became a war. Several hundred armed men surrounded Bower Hill, the fortified home of General John Neville, the regional tax inspector. Shots were exchanged, the rebel leader James McFarland was killed, and Neville's house was burned to the ground. Within weeks, as many as 7,000 angry frontiersmen mustered at Braddock's Field outside Pittsburgh, and there was open talk of marching on the federal arsenal, even whispers of leaving the Union altogether and seeking terms with Britain or Spain. President Washington understood exactly what was at stake. If a tax of the national government could be nullified by a mob, then the Constitution was 7 years old and already dead. He federalized nearly 13,000 militiamen from 4 states, a force larger than most armies he had commanded in the Revolution, and rode west at their head. He remains, to this day, the only sitting American president ever to lead troops in the field. Facing that, the rebellion evaporated without a battle. Roughly 150 men were arrested, 2 were convicted of treason, and Washington, having made his point, pardoned them both. But here's the twist that shaped the next 100 years. The government won the battle and lost the argument. Thomas Jefferson, who had warned from the beginning that internal taxes would set the government at war with its own citizens, rode the resentment all the way into the White House. In 1802, one of his first major acts was to repeal every internal tax in the country, whiskey excise included, and run the entire federal government on customs duties alone, and a pattern locked into place that would hold for 6 decades. In peacetime, the tariff paid for everything. In wartime, Congress would grudgingly impose internal taxes, as it did during the War of 1812, and then repeal them the moment the guns fell silent, as it did in 1817. The unwritten rule of American public finance was now carved in stone. Americans would tolerate a tax buried in the price of imported cloth at the harbor. They would not tolerate a federal officer standing on their porch with his hand out. Keep that rule in mind, because the entire story of 1913 is the story of how it was broken. So what did this tariff-funded government actually look like from the inside? Honestly, from a modern vantage point, it barely looks like a government at all. The entire federal civilian workforce at the start of the 1800s numbered a few thousand people, most of them postmasters and customs clerks. There was no Social Security, no Medicare, no Department of Education, no farm subsidies, no federal safety net of any kind. The entire military ran on a few $1 million a year. Even on the eve of the Civil War in 1860, the entire federal budget was still under $80 million a year, a sum the modern federal government spends before lunch. For the average citizen, the national government was the post office, the flag, and little else. It existed, but it existed at a distance, funded by the flow of commerce through its harbors rather than by the labor of its people. Now pause for a second and try this on for size, because it's almost impossible for a modern mind to absorb. If you had lived in that America, here is a list of things that would never once have happened to you. You would never have filled out a tax form. You would never have reported your income to anyone, because as far as Washington was concerned, your income was none of its business. No agency knew your wages, your savings, or what you did with them. When you earned $1, you kept the dollar, and the only federal tax you ever paid was hidden somewhere in the price of your coffee, your sugar, and your imported tools. Your great-great-grandfather didn't opt out of the system you live under. The system simply did not exist, and nobody around him could have imagined that it ever would. That's how completely 1913 rewired the country. It didn't just change a law, it changed what counted as normal. And the tariff wasn't even the whole story, because the young republic was sitting on an asset no European treasury could match: land. Endless, continent-scale quantities of it. As the nation expanded through purchase, treaty, and conquest, the Louisiana Purchase, Florida, Oregon, the vast Mexican cession, the federal government became the largest landowner on earth, and it sold that land for cash. The Land Ordinance of 1785 had already created the machinery: survey the wilderness into neat squares, then auction it. At first you needed to buy 640 acres at $1 an acre, a rich man's threshold. The Harrison Land Act of 1800 cut the minimum to 320 acres and let buyers pay on credit. By the Land Act of 1820, an ordinary family could claim 80 acres at $1.25 an acre, cash on the barrelhead. Year in, year out, land sales added roughly a seventh of what the tariff brought in, but in boom years they exploded. In 1836 alone, more than 20 million acres of public land went out the door, and federal revenue actually outran federal spending so badly that Congress had a new problem nobody has had since: what to do with the surplus. That surplus produced the moment that still reads like fiction. In January 1835, under Andrew Jackson, the United States finished paying off its entire national debt. Zero. No major nation had ever done it. None has done it since. A government with no income tax, no central bank, and a workforce smaller than a modern county school district was, briefly, the only debt-free great power in the world. But fairness demands the other half of this picture, because the old system was not some lost golden age. Start with where the land money actually came from. Every acre the Treasury sold had been cleared of its previous owners, and the 1830s land rushes that filled the government's coffers ran on the forced removal of the Cherokee, Choctaw, Creek, and Chickasaw nations from the American Southeast. The revenue was real, and so was the dispossession underneath it, and the tariff had its own poison. Because here's what a tariff really is. A tax on consumption, which means it lands hardest on the people who spend the largest share of their income just getting by. The Georgia farmer and the New York banker paid the same markup on an imported plow or a bolt of British cloth, but only one of them felt it. The South understood this arithmetic with painful clarity, and in 1828 it boiled over. Congress passed a tariff so aggressive, with average duties climbing toward half the value of imported goods, that Southerners simply named it the Tariff of Abominations. South Carolina did more than complain. In 1832, the state passed an ordinance of nullification, declaring the federal tariff null and void inside its borders, and threatening to leave the Union if Washington tried to collect it. Jackson answered by asking Congress for authority to enforce the law with the Army, and Congress gave it to him in the Force Bill. For a few months in the winter of 1832 and 1833, the United States stood at the edge of civil war. Not over slavery, not over territory, but over a revenue law. Henry Clay brokered a compromise tariff. Both sides climbed down, and the crisis passed. But the lesson was burned into the country's memory. The question of who pays for the government was never a bookkeeping question. It was, from the very beginning, the question of what the Union actually was, and it had nearly split the country 30 years before Fort Sumter. When the real rupture came in April 1861, the comfortable old fiscal world died in a matter of months. The Civil War consumed money on a scale no American had ever imagined. Before the war, the entire government ran on well under $80 million a year. By the war's height, the Treasury was burning through more in a single month than it had once spent in a full year. And at the worst possible moment, the old revenue machine failed, because war strangles trade, and the tariff was a tax on trade. Something unthinkable was about to become law. On the 5th of August, 1861, Abraham Lincoln signed the Revenue Act of 1861, and for the first time in its history, the United States taxed the incomes of its citizens, a flat 3% on annual incomes above $800, a threshold high enough that it touched only a small fraction of households. That first version was a paper tiger, drafted in haste with no real collection machinery, and it raised almost nothing. Congress went back to work. The Revenue Act of 1862, signed on July 1, built the real thing, a progressive income tax, 3% on incomes above $600, 5% above $10,000, and by the 1864 Act, the top rate had climbed to 10%. For the first time, the amount you owed your government depended on how much you earned. And the income tax was only one gear in a much larger machine. The 1862 law taxed nearly everything a human being could touch: liquor, tobacco, playing cards, carriages, billiard tables, yachts, gunpowder, telegrams, patent medicines, newspaper ads, inheritances, professional licenses. One official of the era joked that Congress had followed the old fairground advice: wherever you see a head, hit it. More consequentially, the act created a brand new office inside the Treasury, the Commissioner of Internal Revenue. It began with a handful of clerks. Within months, it had thousands of assessors and collectors fanned out across the loyal states. Many of them paid commissions on what they brought in. Read that again. A federal revenue agency, with agents in every district, created as a temporary war measure. Institutions born in emergencies have a way of outliving them, and this one was no exception. It survives today under a name every American knows: the Internal Revenue Service. Even so, taxes of every kind covered only about a fifth of the Union's war costs. The rest came from borrowing on a revolutionary scale, $500 million in war bonds that the financier Jay Cooke marketed door-to-door to ordinary families, the first mass retail bond drive in history, and from an even more radical invention: the greenback, $450 million of paper money printed on the government's own authority to pay its soldiers and suppliers. War didn't just change how much the government took, it changed what money itself was. But that's a story for another video. Here's the part of the Civil War tax story everyone forgets, and it's the hinge of this entire history. The income tax was kept, then it was killed. At its post-war peak, it was collecting over $70 million a year, and it had proven beyond argument that a national income tax could work. And precisely because the emergency had passed, and because high tariffs and whiskey and tobacco excises were filling the Treasury to overflowing, Congress let the income tax die in 1872. The wartime promise had been honored. Temporary meant temporary. For the next 22 years, the United States went back to being funded almost entirely by customs duties and sin taxes, roughly 90% of federal revenue from those two sources alone. Most Americans assumed the income tax had been buried for good, but the country, the old system had been built for no longer existed. This was the Gilded Age now. The America of Rockefeller, Carnegie, and Morgan, of railroads and trusts and fortunes beyond medieval imagination, and of tenements and 12-hour shifts a few blocks from the mansions. And the tariff, the painless tax, the invisible tax, was starting to look like neither. Farmers in the South and West did the math and realized they were paying inflated prices on everything they bought so that northern industrialists could be shielded from foreign competition. The protection racket ran on lobbying. Every tariff bill became a feeding frenzy of industries buying higher walls for themselves. How central was this fight? The entire presidential election of 1,888 was waged, more than on any other issue, over the tariff, with Grover Cleveland demanding cuts and Benjamin Harrison defending the wall of protection. Harrison won the White House while losing the popular vote, and his party promptly rewarded its industrial backers. When the McKinley tariff of 1,890 shoved average duties on protected goods toward 50%, the backlash helped ignite the populist revolt, and the optics grew impossible to defend. Andrew Carnegie's personal income in a single good year ran into the tens of millions of dollars, untaxed, while the men in his mills worked 12-hour shifts 6 days a week and paid the tariff's markup on nearly everything their families consumed. You didn't need to be a radical to see the problem, you just needed to be able to count. Then came the panic of 1,893, hundreds of banks failing, the worst depression the country had yet seen, and a question that refused to stay quiet any longer. Why is the cost of this government loaded onto the people least able to carry it, while the largest fortunes in human history contribute almost nothing? Out of that fury came the idea's return. In 1894, Congress attached a 2% tax on incomes above $4,000, comfortably over $100,000 in today's money, to the Wilson-Gorman Tariff Act. It was America's first peacetime income tax, aimed squarely at the rich, and the political theater around it was remarkably cynical. Plenty of congressmen voted yes, while privately betting the Supreme Court would strike it down and spare them the consequences, which is exactly what happened. In Pollock versus Farmers Loan and Trust Company, decided in 1895, the court ruled 5-4 that a tax on income from property, rents, interest, dividends was a direct tax and therefore unconstitutional unless apportioned among the states. The founders' old lock, dormant for a century, had just been snapped shut on the modern world. The courtroom rhetoric tells you what was really at stake. Joseph Choate, the corporate lawyer arguing against the tax, called it communistic in its purposes and tendencies. Justice Henry Brown, dissenting, fired back that the decision amounted to nothing less than a surrender of the taxing power to the moneyed class. One case, and the two Americas of the Gilded Age were staring at each other across the bench. The decision didn't settle the question, it lit the fuse. For the next 14 years, the income tax became a permanent plank of populist and progressive politics, pushed forward by the muckrakers, the labor movement, and a rising generation that saw the Pollock ruling as the Constitution being used as a shield for concentrated wealth. And then came the twist nobody saw coming. The breakthrough was delivered by a conservative. In 1909, President William Howard Taft, no radical by any stretch, proposed a constitutional amendment granting Congress the power to tax incomes from whatever source derived, without apportionment. Here's the delicious irony buried in the record. Some of the conservative senators who allowed the amendment through did so as a maneuver, calculating that 3/4 of the states would never ratify it and the issue would finally die. It was one of the great miscalculations in American political history. State after state said yes, and on the 3rd of February 1913, the 16th Amendment crossed the 36-state threshold and became part of the Constitution. The wall the founders built in 1787 had stood for 126 years. It came down in a single sentence. Congress didn't wait a year. That October, the new Revenue Act of 1913 imposed a 1% tax on incomes above $3,000, rising through surtaxes to a top rate of 7% on incomes over $500,000. And notice the poetry in the paperwork. That income tax was written into the Underwood Tariff Act, the very law that slashed tariff rates. The old system and the new system passed each other in a single piece of legislation, one on its way out, one on its way in. At the start, the income tax was a tax on the rich alone. Only a few percent of American households owed anything at all, and the money it raised was a fraction of what customs still brought in. Its defenders called the fears about it hysterical. Its opponents predicted it would grow beyond anyone's control. You already know who turned out to be right. And for those keeping score of that particular year, the same 12 months that gave America the income tax also gave it the Federal Reserve. 1913 was, by any measure, the busiest year in the history of American money. We've covered that other 1,913 creation in its own video. Because what happened next followed a law of politics as reliable as gravity. A tax born small never stays small, it waits for an emergency. The First World War arrived barely a year later, and the numbers tell the story better than any argument. The top rate stood at 7% in 1913. By 1916, it was 15. By 1917, 67. By 1918, 77%. When peace came, the rates drifted down but never returned home. The machinery was too useful. Then the Second World War finished the transformation. In 1939, fewer than 4 million Americans filed an income tax return. By 1945, nearly 43 million did. In 6 years, a class tax became a mass tax, with the top bracket brushing 94%, and Washington enlisted every tool of persuasion it had, including Donald Duck cartoons in movie theaters urging audiences to pay their taxes to beat the Axis. And in 1943 came the most brilliant, most consequential, least discussed innovation in the entire history of American taxation, withholding. Under the current Tax Payment Act, employers were required to deduct the tax from each paycheck before the worker ever saw the money. Feel the genius of that. Nobody writes a painful annual check anymore. The tax simply never arrives in your hands in the first place, subtracted invisibly, week after week, inside the machinery of payroll. Millions of Americans went from paying taxes to receiving refunds, and started thanking the government in April for returning a slice of what had been theirs all along. Whatever you think of taxation as a piece of psychological engineering, withholding may be the single most effective policy design of the 20th century. So step all the way back and look at what was actually traded away, because the old system and the new one weren't just two ways of raising money. There were two different theories of the state. The tariff system carried a built-in ceiling, pushed duties too high and imports shrink, and the revenue shrinks with them, a self-limiting engine that helped keep federal spending around 2 or 3% of the national economy for a century. The income tax has no such ceiling. Once the government could tap wages and profits directly, revenue scaled with the entire economy, and ambition scaled with revenue. Social Security arrived in 1935, Medicare and Medicaid in 1965, and the federal government spread into education, housing, energy, and 100 domains Hamilton never dreamed of. Today, taxes on individual income and payroll supply more than 8 out of every 10 federal dollars, while the tariff, the engine that once carried everything, spent a century as a rounding error. Though notice, and this is the strangest turn of all, that in the last few years tariffs have come roaring back into American politics for the first time in generations, pitched once again as a way to fund the government from the border instead of the paycheck. The oldest argument in American finance is not history, it's the news. Let's be honest about both sides of the ledger, because nostalgia is its own kind of lie. The world before 1913 was no libertarian paradise. It was a world with no cushion against bank panics, no protection for the elderly or the injured, a world where the tariff quietly overcharged the poor, where the land revenue was extracted from dispossessed nations, and where a revenue dispute nearly shattered the Union in 1832. But it was also a world where the federal government's hand never entered a private paycheck, where the state was funded by the commerce that passed through its ports rather than by surveillance of every citizen's earnings, and where a person could live and die without once being asked by Washington to account for their labor. Whether the trade was worth it is not a question a video can answer for you, but you should at least know the trade was made, because you were never asked, and neither was anyone alive today. Which brings us back to where we started, to the wall the founders built. They were not naive men. They assumed that any government able to reach directly into its citizens' earnings would eventually do exactly that, as deeply as it could, forever. So they wrote the reach out of the Constitution, and their wall held through rebellion, expansion, and a civil war for over a century. It took the greatest concentration of private wealth in human history to build the pressure, one Supreme Court case to expose the wall, and one constitutional sentence to bring it down. Every fight over taxes since, every promise that a new levy will be small, temporary, and aimed only at the rich, is an echo of that collapse. Because in the end, the question of how a government gets its money was never really about money. It's about power. Who carries the burden? Who escapes it? And who gets to decide? That question was standing on the docks of New York Harbor in 1789. It was standing in the whiskey stills of Pennsylvania and the State House of South Carolina. And it's standing in your paycheck right now. If this story changed the way you look at the systems running quietly underneath your life, subscribe and drop a like. It genuinely helps the channel keep digging. We go deep into the hidden machinery of money and power, the deals and decisions that built the world you were born into and never voted on. And if you want to keep pulling this thread, There's another video coming very soon that you will not want to miss.